The warning for 2026 is no longer a forecast. It is a mathematical certainty. While the mainstream media debates a soft landing, America's largest home builders are quietly executing a mass liquidation. Lennar, the second largest builder in the nation, has slashed net effective pricing by 27% from peak valuations, plummeting from a $511,000 average to $375,000 to offload inventory before the floor collapses. President Trump has publicly branded these corporations as OPEC, accusing them of manipulating supply while sitting on record land banks. In the Sun Belt, inventory is rotting on the market, with Florida properties now trading at 30 to 40% losses as the condo crisis accelerates. The smart money is screaming, "Get out," yet millions of homeowners remain paralyzed in denial. The question isn't if the crash is coming. It's whether you can escape the trap before the exit doors weld shut. The warning for the United States housing market in 2026 is not being whispered in backrooms, it is being screamed from the balance sheets of the nation's largest construction firms. The data is unequivocal. As we enter this new fiscal year, home builders are delivering a message that dismantles the narrative of a perpetual bull market. We are staring down the barrel of a widespread correction, a scenario where home prices are not merely stabilizing but are actively being severed, with potentially catastrophic price cuts targeted at specific vulnerable states. This is not speculation. This is the operational reality for the entities that control the supply. When we analyze the 12-month forecast for 2026 derived from underlying data on inventory price cuts and days on market, the map of America bleeds red. The forecast projects a downward trajectory for approximately half of the United States. In certain pockets, specifically neighborhoods saturated with new inventory, we are forecasting value declines reaching double digits in 2026. The mechanism for this decline is simple: brutal supply and demand. There is simply too much inventory sitting stagnant on the ledger. To understand the severity of this capitulation, we must look at the giants. Lennar, the second largest home builder in America, has become the bellwether for this devaluation. In 2022, Lennar's typical average selling price on new orders hovered at a peak of $511,000. Today, that figure has collapsed to $375,000. This represents a 27% decline from the peak. This is not a cooling market. This is a crash in asset value that has already occurred on the books of the builders, but the raw price drop is only the surface of the financial engineering taking place. Deep within their fiscal reports, specifically their fourth quarter earnings for fiscal year 2025, Lennar confirms this systematic reduction. The company is actively sacrificing gross profit margins, allowing them to plummet to approximately 17%, in a desperate bid to maintain liquidity and clear inventory. They are effectively buying their way out of the market. They are utilizing their massive capital reserves to engage in rate buydowns, purchasing lower interest rates, often sub 5%, on behalf of buyers to artificially stimulate demand that simply does not exist at natural market rates. This is a luxury that you, the individual homeowner, do not possess. You cannot buy down a buyer's rate by 2 percentage points. You are fighting an enemy with deeper pockets who is willing to slash prices to survive. This behavior has reached the highest levels of political scrutiny. President Donald Trump has publicly attacked these entities, drawing a parallel that should terrify any real estate investor. He has compared America's home builders to OPEC, the oil cartel. Trump explicitly accused them of hoarding land, sitting on a record 2 million empty lots to manipulate pricing. But the irony is that despite this accusation of hoarding, the builders are now forced to flood the market. We see this playing out in real time in the American South. In northern Alabama, regional builders are executing massive price cuts. Walk through a development in Athens, Alabama, and you will witness the absurdity of the current market structure. In a single subdivision, there are over 26 homes currently sitting for sale. This is a massive glut of inventory. The listing history reveals the desperation. Prices have been slashed by $50,000, bringing homes down to the $240,000 range. Yet, the machinery of construction does not stop. Even with 26 unsold units rotting on the market, even with the price cuts bleeding their margins, they are clearing more land. The forests are being leveled for more supply. It appears they are preparing to double the size of developments that cannot even sell their existing stock. This is the trap of the modern builder. They cannot stop. Their business model is predicated on volume, on the pace of starts. If they stop building, they die. So they build into a glut, driving prices down further in a suicidal feedback loop. This phenomenon is not isolated to Alabama. It is spreading like a contagion across the Sun Belt. Near Nashville, Tennessee, the Titan DR, Horton is capitulating even faster. I toured a site in Lewisburg where they are offloading townhomes for $199,000. These are price points we haven't seen since the pre-pandemic era. This is a reversion to the mean that destroys equity for anyone who bought in the last 3 years. The builders are the smart money in this equation. They are not emotionally attached to the kitchen island or the backyard view. They view the house as a liability on a balance sheet that must be liquidated. They will not sit around for 2 years holding inventory like a stubborn homeowner. They will cut the price to the bone. They will offer incentives. They will do whatever is necessary to move the asset, and this is where the divergence begins. While Lennar and D.R. Horton are slashing prices by 27% or selling at $199,000, the regular resale market, the neighbors down the street, are doing nothing. They are holding firm. They are refusing to cut. This has created a bifurcated reality where new homes are crashing in price while existing home listings remain delusionally high. But the builders are the leading indicator. They are the canary in the coal mine. When the entity that constructs the product decides the product is worth 30% less, the rest of the market will eventually, inevitably, be forced to agree. The warning signs are flashing neon red. The inventory is piling up. The price cuts are institutionalized. Even the president is posting about it, moving this crisis from industry gossip to mainstream news. The builders are getting out. They are taking their hits, cashing out their chips, and leaving the table. The question you must ask yourself is, why are you still trying to buy in? The American housing market has fractured into two distinct schizophrenic realities. To speak of a national housing market in 2026 is to engage in a statistical lie. We are witnessing a great bifurcation, a violent tearing apart of economic trends where geography has become the primary determinant of financial survival. While the builders in the South are engaging in a race to the bottom, a completely different phenomenon is occurring in the Northeast and the Midwest. While prices are hemorrhaging in Alabama, Tennessee, Florida, Texas, and Arizona, they remain stubbornly frozen or even rising in markets like New York and Illinois. This contradiction is not a sign of health. It is a symptom of a broken system. The home builders, the architects of the Southern crash, barely exist in the Northeast. They do not build mass subdivisions in New Jersey or Chicago due to land constraints and zoning gridlock. Consequently, these regions are starving for inventory, artificially propping up prices even as affordability evaporates. This creates a dangerous illusion of stability. It allows pundits to claim there is no crash. But make no mistake, this is not a synchronized national decline like 2008. It is a rolling recession, hitting pocket by pocket, neighborhood by neighborhood, and the first casualty is the Sun Belt. In these crashing markets, we observe a psychological pathology among existing homeowners: denial. There is a profound disconnect between the new market and the resale market. While D.R. Horton sells townhomes for $199,000, the neighbor down the street, who has lived in his house for 5 years, refuses to adjust his price. He is suffering from the delusion that his asset is immune to the laws of supply and demand. This resale denial is the friction point of the 2026 economy. Sellers are not cutting prices. They are simply pulling their homes off the market. We have seen a massive spike in delistings at the end of 2025. These sellers are clutching to a narrative that died 2 years ago. The narrative that real estate always goes up. They have forgotten the lessons of the Great Recession, where prices fell 25% nationally. They are waiting for a recovery that the data says is not coming. They believe 2026 will bring buyers back, It will not. To understand the depth of this value destruction, we must look at the anomaly of Athens, Alabama. This region serves as the perfect case study for the builder's trap. Geographically, this area should be booming in value. It is located just 20 minutes west of Huntsville, a city exploding with economic power. Huntsville is not a rural backwater. It is a hub of the American aerospace and defense industry. The FBI has established a massive presence here. Boeing and Lockheed Martin are entrenched. The U.S. Space Command is relocating from Colorado Springs. The demographics here are elite. The median income in this specific pocket approaches $100,000. The local schools are rated 9 out of 10 on Zillow. You have a high-income population, a surge of PhDs and engineers, and robust job growth. In a normal market, prices would be skyrocketing. Yet the opposite is happening. New homes here are selling for as low as $240,000. The intrinsic value of the dirt and the structure is collapsing despite the high incomes. Why? Because the supply is overwhelming. For the opportunistic investor, the vulture capitalist, this wreckage presents a rare mathematical opening. The cost of ownership in these bleeding markets has dropped to levels unseen in half a decade. In Alabama, property taxes are negligible, approximately $800 to $850 per year on these new homes. Insurance costs are manageable. When you combine a $240,000 purchase price with a median rent of $900 to $2,000 a month, the yield resurfaces. We are seeing cash-on-cash returns, or cap rates, hitting 6% or even 7% for cash buyers. These are numbers that disappeared during the pandemic bubble. But let us be clear, this yield exists only because the asset value has been decimated. You are buying a falling knife. The contradiction is stark. In the same subdivision, you have homes sold, homes sitting vacant, and empty lots being cleared for more homes. The builder is cannibalizing its own product. They are diluting the market further every single day. Meanwhile, looking further south, the situation in Florida has metastasized into a full-blown crisis. The downturn there has accelerated beyond mere correction. Since I left the state, the decay has quickened. Listings in Florida are now closing at 30% to 40% losses. We are seeing the return of the ugly vocabulary of 2008, foreclosures and short sales. Florida is hitting another gear of decline. It is leading the nation in inventory pileup. And unlike the sellers in Alabama who might hold on, the condo owners in Florida are being forced out by skyrocketing HOA fees and insurance premiums. They are not selling because they want to. They are selling because they are insolvent. This is the state of the union in 2026. A builder-led liquidation in the South, a frozen standoff in the North, and a resale market populated by sellers living in a fantasy world. The builders have made their move. They have cut the prices. Now the rest of the market must face the inevitable gravity of correction. The denial phase is ending. The acceptance phase and the pain that comes with it is about to begin. The final piece of this collapse is not found in the soil of Alabama or the lumber yards of Tennessee. It is found in the machinery of the financial system itself. For years, the narrative has been that high interest rates are the villain, and that once the Federal Reserve pivots, the buyers will return and the party will restart. This is a lie. The rot is far deeper than the cost of borrowing money. The admission has finally come from the highest levels of the United States government. Treasury Secretary Scott Bessent, effectively the CFO of the nation, has broken rank with the optimism of the previous administration. He has publicly stated that the housing market is effectively in a recession. This is a critical acknowledgement. While the broader GDP may be propped up by government spending and tech speculation, the housing sector, the primary vehicle of wealth for the American middle class, is contracting. But here is the trap. The builders have already priced in this recession. They are surviving it by weaponizing their balance sheets in a way no individual homeowner can match. This is the era of the rate buydown. While you, the regular seller, are stuck offering a 6.5% or 7% mortgage to potential buyers, giants like Lennar and D.R. Horton are playing a different game. They are not just selling houses, They are selling financing. They are using their capital to pay the banks up front, artificially buying down the interest rate on their loans to 4.99% or 5.5%. This is how they are moving inventory while the resale market freezes. They are effectively subsidizing the monthly payment to hide the fact that the purchase price is still historically elevated. This financial engineering creates a distorted reality. It explains why new home sales have seemingly held up while existing home sales have plummeted to near record lows. The builders are buying their volume. The regular seller is left stranded, unable to compete, forced to watch their property sit on Zillow for 100 days, 200 days, until they either delist or capitulate. And the buyers? They are not fooled. The data from over 5,000 respondents in our recent polling reveals the true psychology of the 2026 market. The industry prays for lower rates, but the buyers do not care. Only 5% of potential buyers stated they would enter the market if rates dropped. Contrast that with the 40% who stated they would only buy if prices dropped. The American consumer has done the math. They know that a 6% mortgage rate is historically normal. What is abnormal is the price. Home values exploded by 50% during the pandemic, while wages and income only rose by 25%. The gap between income and asset prices has stretched to a breaking point. No amount of rate cuts can bridge that mathematical chasm. Only a reduction in the principal price can restore equilibrium. Nowhere is this painful rationalization more visible and more violent than in the state of Florida. If Alabama is the warning, Florida is the crash site. The state is currently facing a perfect storm that extends beyond simple supply and demand. It is a regulatory and insurance apocalypse. We are witnessing a condo crisis of historic proportions. Following the structural failures of the past, new safety laws have triggered a shockwave of assessments. Condo associations are doubling or tripling their monthly HOA fees to build mandatory reserves. Retirees on fixed incomes who thought they owned their slice of paradise are suddenly facing monthly bills they cannot pay. The result is a mass exodus. Condo inventory in Florida has spiked by 37% year over year. Desperate sellers are dumping units, leading to price crashes of 33% to 40% in some high-density coastal markets. We are seeing foreclosures begin to tick up, with Florida now leading the nation in foreclosure starts. This is the exodus in reverse, a forced liquidation of assets because the carrying costs have become mathematically impossible. Even the policies of the new Trump administration present a double-edged sword. While the president rails against the OPEC builders, his protectionist trade policies are adding friction to the bottom line. Tariffs on lumber, steel, and aluminum are estimated to add approximately $1,750 to the cost of building a single-family home. This creates a hard floor for the builders. They cannot lower prices indefinitely without bleeding cash. If they cannot lower prices enough to meet the buyers, and they cannot raise prices due to the glut, their only option is to stop building. This leads us toward a stagflationary nightmare: high costs, low volume, and a frozen market. The verdict for 2026 is etched in the data. Zillow recently reported that over 50% of homes in the United States saw their estimated value drop in 2025. More than half of the American housing stock is now worth less than it was at the peak. The narrative of equity forever is dead. We are entering a period of great deleveraging. The 45% of people who said they are definitely not buying in 2026 are the smart money. They are waiting. They are watching the inventory pile up. They are watching the price cuts spill over from the new builds to the resale market. The builders have shown their hand. They are cutting 27%. They are selling to anyone who can sign a contract. The government has admitted the recession. The only people left holding the bag are those who refuse to believe the party is over. If you are a buyer, patience is your only weapon. The inventory is coming. The distress is building. The builders will cut again. If you are a seller, especially in the Sun Belt, the window is closing. You are competing against a corporate machine that is willing to lose money to survive. You are not. The housing market of 2026 is not a market of opportunity. It is a market of survival. The crash isn't coming next year. It's here. It's just not evenly distributed yet. But give it time. Gravity always wins.